Today I'm doing a video on PepsiCo, ticker symbol PEP. Pepsi is one of those dividend kings that has been paying a dividend for over 50 years and has increased their dividend over that time period. Now this video is structured into 4 parts. The first part, we're going to talk about the business, what they do they have any competitive advantage. The second part is doing a financial overview going back on a 10-year history of PepsiCo. Then we're going to do a stock valuation based on 4 different valuation methods. And fourth, we're going to do a return on investment, what I would expect to get from the stock based on today's stock price or future prices. Pepsi is a huge company that owns a lot of different brands that people may not realize are PepsiCo products. For example, Mountain Dew, Fritos, Gatorade, Quaker, Sun Chips, Rockstar, of course, Pepsi, bubbly sparkling water, and much more. Their products are really split into 2 different categories, so convenient foods and beverages. So 58% of their business is in convenient foods, while 42% is in beverages. They're a leading position in snacks, and in regards to beverages, they're number 2 globally. They sell their products across the world. 52 billion or 61% of their products are sold in North America. Also 34 billion or 39% is outside of North America. So they definitely are a strong global company. They've seen organic growth in that 9% range over the last few years, which is absolutely incredible for a company this size. If we dig down and look at specific brands, you can see that Gatorade had a 13% revenue gain. That's on a CAGR basis, so compounded each year over the last few years. Doritos at 11%, Cheetos at 11%, Lay's at 9%, Mountain Dew at 8%, and then Pepsi at 7%. So those are really impressive organic numbers. Now, I think a lot of investors would assume that Pepsi doesn't have much room to grow because they're so big, but that is not the case. In fact, if we look at, convenient food, for example, they own about 8% of that space. So about 599 billion, say about $600 billion of that space, they only own 8%. Now, the global beverage opportunity, they own roughly 9% out of $626 billion. So in both cases, Pepsi still has a very small part of the market. So there is certainly opportunities to grow. One big positive about PepsiCo is that management has put a lot of money into shareholders' hands over the past 5 decades. In fact, if you look at their 2022 allocation alone, half of their allocation went to dividends, about 40% went to CapEx to go back into the business and build it. They also did a big chunk in share repurchases and then portfolio construction. So they do have a big emphasis on the business, on making shareholders a priority on the back end. Now, I mentioned at the beginning of this video that PepsiCo is a dividend king, which means they've been paying a dividend consecutively for over 50 years, and they've grown it during that time frame. So you can see here, since 2010, they've grown their dividend almost 8% per year, which is absolutely incredible. During that same time frame, you can see their share repurchases at the very bottom of the screen as well. And they've repurchased over $30 billion worth of their stock going back to 2010. Next, let's take a look at their financial history. So I like to go back 10 years to see how the company has performed overall. So we'll take a look at the big 5. So sales per share growth, earnings per share growth, free cash flow per share growth, book value per share growth, also return on capital. Now, I like to use the per share basis approach because it factors in share issuances and share buyback. So let's take a look at that now. So on the screen here, you can see the 10-year financial history of PepsiCo. Their enterprise value has grown from $146 billion in 2013 to $267 billion here today. Now, their sales per share growth over the last 10 years has grown 4% per year. EPS has grown 3%. Free cash flow has grown 1%. Their book value per share has actually dipped -1%. This is on a CAGR basis, so compounded growth rate. The ROIC, 14% on average over the last 10 years, was phenomenal. Now, as far as debt goes, their long-term debt payoff based on their operating income is about 5 years. So it take them 5 years to pay off their total debt, or long-term debt, that is, based on their operating earnings. Their debt to equity is around 253% here today. Current ratio is a 1.1. Their PE average over the last 10 years has been a 25. Gross margin 54%. Operating margin is at 15% over the last 10 years. Now, taking a step back and looking at these numbers, there's a couple of things that stick out to me right away. First is very consistent margins for this company. I mean, gross margins have been between 53 and 55%. Operating margins have been anywhere from 14 to 17%. Very consistent year over year. Their return on invested capital is absolutely fantastic, averaging about 14% over the last 10 years, but it's been pretty consistent year after year. So if you've owned this company for the last 10 years, you'd be pretty happy where you're at today based on the stock price. Now, as far as some of the cons I see on this is, first off, their debt situation is not very good. I mean, long-term debt payoff is about 5 years. I like to see that being under 3 years. Their debt to equity, I would like to see around 100% or less. In both those cases, they're much higher than I would like to see. Also, what's really interesting as well is their book value per share has actually gone down over the last 10 years. Interestingly enough, their equity was much higher in 2014. Their assets were as well versus their liabilities. So I'm not sure exactly what happened as far as the business between 2014 and 2015. On the surface, it looks like the company either bought maybe another company with debt, or they put a ton of money back into CapEx to grow the company organically. So something happened between 2014 and 2015. But what's also interesting is that the PE, what the market was willing to pay for the company, jumped up significantly in 2015. So there must have been a huge growth trajectory that the company had shown from 2014 to 2015, and they've been able to really leverage that over the last several years, because in 2015, their sales per share around $44, and now it's at $66. So their growth on the top line has actually grown faster than even on their bottom line overall. Also, what stands out to me is that the market has been willing to pay a premium for this business. So when you're talking about the market paying a 25 or a 26 or even a 28 here today for a PE, that is a pretty high premium for a food company, in my personal opinion. But you're going to see something similar to that, even higher than that, actually, when you look at Coca-Cola. So these types of businesses, which are very consistent, put a lot of money back into the shareholders' hands via dividends and share buybacks. The market is willing to pay more for these type of companies. Next, let's take a look at a valuation for this company. What is the intrinsic value? And we're going to look at 4 different models that look at different things. So the first one is a margin of safety calculator, specifically looking at earnings per share growth over the next 5 years. Next one is a discounted operating earnings model, basically forecasting operating earnings into the future and then discount it back today based on net present value of future operating earnings. Next is the 10 cap, so that's specifically looking at owners' earnings of the business. And fourth is payback time, which is basically looking at free cash flow over the next 10 years. And then from there, we can project on what the intrinsic value or what the buy price should be based on today's free cash flow earnings. So the first valuation model we're taking a look at is the margin of safety calculator. So I think an average or a standard EPS for Pepsi is about $7. I think their growth from earnings per share basis is going to be around 9% per year over the next 5 years. That would give me a growth multiplier of 1.54 and an EPS multiplier of 10.77. So that would put a target buy price of around $65, but the stock is trading $167 here today. Now, it doesn't surprise me that the target buy price is much lower because of the higher multiple that the market has been willing to pay for PepsiCo. But it doesn't necessarily mean that's not a buy right now. We need to look at the other valuation templates to determine. Next valuation template is my discounted operating earnings model. So for what I'm trying to do here is try and project out sales over the next 5 years. From there, I'm trying to figure out what I think the operating margin is going to be for the business. Then I can calculate operating earnings over the next 5 years. From there, I try to determine what I think the market multiple, or what the multiple the market is willing to pay for this company. And then from there, I can get my net present value future earnings and get to my intrinsic share price. So I think sales is going to grow on 6% per year over the next 5 years. I think operating margins will stabilize around 15%. So that gives me operating earnings growth of around 7% per year. I'm calculating a future stock price of $326 in 2027 based on a multiple of 26. Gives me an intrinsic share price of $162 here today. Next valuation method is the 10 cap valuation. So this is looking at operating cash flow of business, also looking at capex, and then tax provisions. What would be kind of a normalized number for all three of those for this business? And then from there, I can get to total owners' earnings of the business, which I'm coming to about $11 billion here today. Based on 1.3 billion shares outstanding, I get owners' earnings per share of 8. I multiply it by 10. That's how you get the 10 cap. So I get a buy price from the 10 cap method at $80, which is about half of what the stock is here today. But very similar to the margin of safety calculator, I'm not too surprised that that number is low because of the higher multiple that the market has been willing to pay for the business. So next, let's go take a look at the payback time method. So the payback time method looks at free cash flow of the business. I think normalized free cash flow of the business is roughly $9 billion. So from there, I believe from all the research I've done that their free cash flow is actually going to grow faster than their earnings per share and even their sales per share as well. So I think their free cash flow is going to grow around 15 to 16% per year over the next several years. So based on this information, I would get my money back that I put into the business today after 10 years, which for me is not good enough. I want to get my money back in about 8 years, which is about half of what the market expects to get on an average stock. And that is from a historical standpoint. So if you look at the market as a whole over the last several decades, the average PE for the entire market has been around a 16. So if we can get it back in an 8, then we have a good margin of safety that we're buying the stock price at. So to summarize all those valuations real quick, so my discounted operating earnings model suggests that the fair value of the stock is $162 here today. So I would say that the stock is trading at fair value. A 30% margin of safety, that buy price would be 114. Payback time would be a buy price of 108. 10 cap would be 80, and then margin of safety calculator at 65. So the top two valuation models there do suggest that is trading at fair value here today. All right, so what would I expect from the stock or return from the stock based on today's stock price of $167? Well, I would expect to get around a 10% return over the next 5 years based on the assumptions that I made. So what were my assumptions? Well, sales growth at 6%, operating earnings at 7%, and then assuming the market is willing to pay a 26 multiple for this company. Now, this does not include the dividend or the dividend yield. So if you factor that in, I would expect to get a 12 to 13% return on the stock price here today. Now, if you're looking at this video in the future, the stock drops down to $130. I would calculate a return on investment of 15% just from the stock, and then roughly 18% if you factor in the dividend. So again, I do think at $167 here today, I do think it is trading at fair value. So that was my stock analysis on PepsiCo Company, ticker symbol PEP. Now, if you would like to support the channel, I have a couple of different ways to do so. I have Patreon where you can access valuation templates. So a lot of the valuation templates I showed today I actually have on my Patreon, and I have a video explaining how to use those on calculating intrinsic value of a company. You also get access to my Discord channel as well. There's over 100 people on there. And you also get access to Patreon only posts. So if that is something you would like to do, I'll put a link down in the description below. Thanks again for watching. Happy investing, everybody. Take care and catch you in the next video.